I'm going to turn the time over to you, Len. You can introduce yourself, kind of give the history, and move from there.
Well, thanks, Chris. Really appreciate the opportunity to be here, not just to get out of the heat, but also just to come here. It's one of my favorite places. And for any of you that are clients of ours, I really appreciate your business and the chance to manage your portfolios. So I thought today, basically I was given a series of topics to cover here today. And so, bonds, a safe haven or a bubble about to burst. And one of the things that Chris was really, that I picked up from his little presentation there, was that everybody seems to be worried about something. So it's kind of like, what are you worried about? Are you worried about inflation? That, it's kind of like the economy's so bad, there's so much debt, all we can possibly do is inflate our way out of it. I mean, I hear that all the time. Are you worried about deflation, that the economy's going to slip into another recession and prices are going to go lower? Or the unemployment rate. I mean, the labor participation rate's at a 30-year low right now, even though unemployment, is only a little over 8%. There's fewer people that are actually in the workforce right now. The dollar. I mean, this was everybody's favorite topic a couple of years ago because everybody knew the dollar had to go down because things were such a mess over here. And actually, it's done a little bit better. The other one that seems to be most everybody's favorite is rates are so low they can't go any lower. Of course, they don't look at Japan where rates basically just went down and have stayed there for 20 years. So, and then the last one, deficits are out of control. I just put, this can't possibly be good. It's kind of like we all know it's bad, but how bad is it and what are we going to do about it? Actually, I would say one of my biggest worries, or what I think is one of the single biggest problems today, is there's just too much debt. Now this chart takes you all the way back to 1792, and it shows just the amount of federal debt as a percent of GDP. If you look at the one spike, that's the highest one where it got up over 120%, that was during World War II. And so that was really kind of a special situation where, it's like everything stopped and we were at war. It was just a major impact, just a major thing that took place in our economy. And after the war was over, everybody came back and then they were ready to have kids and buy houses, and the economy did well, and you can see the amount of debt went down. But if you take that one blip out of there from World War II and you look at that chart, you can see that we're really at a very high level of debt as a percent of GDP. And I'm not looking back over just, most people like to look at things since World War II. I mean, let's look back over, a couple of centuries, and you can see that that's a big number. One of the things that's happened is there's been, that we've looked at, or one of the things that we've looked at has been studies about what happens when an economy has too much debt in it. And one of the things that happens is it just becomes a drag on economic growth. I would say that and if you let's just use common sense. What if you have too much debt? Let's say your credit cards are maxed out, your house is underwater. What if the Fed lowers interest rates? Are you going to go out and buy a new house? Probably not. You can't sell the one you got. How can you buy another one, right? Are you going to go out and buy a new car? Or, are you going to spend money on this or that? I mean, that's really how the economy works when you put everybody together. It's just like how it would be for you and me. And really how we got into this situation is the government's more or less tried to manage the economy over the last few decades. In fact, I don't know if you remember, Greenspan had a book out where he was called the maestro. It was like, he was conducting this orchestra called the economy. And he was really fond of talking about how great financial innovation was. Do any of you guys remember that? And really what that was is that was code for subprime mortgages and all of these risky investments, risky loans that were made in the real estate market. Also, some of the unintended consequences of having too much debt in the economy is that we have a low savings rate. And by having low savings, we're not investing a lot in capital, plant and equipment. Education is being cut back. If you just, I mean, all you gotta do is turn on your TV and you can see what's going on there. Teachers are being laid off. Also, we're in a situation where, when I was in college, they called it pushing on a string. This type of environment that we're in, where the monetary tools of the Fed are relatively useless. They just don't get the desired results. So the Fed talks a good game, and well, you know, we're going to do whatever is necessary to get things going and this and that. But really, if you look at what they've done, it hasn't been all that effective. It's been effective enough just to keep us growing at a couple % a year. If you look at the bars below the line, that's really showing debt that's being liquidated. If you look at the bars above the line, that was the accumulation of debt. And this chart starts in 2006. So you can see from 2006 through about the end of '08, there was still a lot of debt that was being accumulated, and that's for all different sectors. That would be, you know, household debt, business, local government, federal government, and domestic financial sector. The big lines, the big bars underneath there really represent the domestic financial sectors, or the banks, you know, deleveraging. And you can see that what's happening is there's been just a huge amount of loans that have just been taken out of the system. When you think about this, just think back to when you were in college, you were in an economics class. Do you remember the money multiplier? You know, basically you put a dollar in a bank, and that bank loans somebody else, you know, $10, and then that guy buys something, and, you know, then that other bank loans it. And so the money, as it moves through the system, has a multiplier effect. What we have going on right now is what I call a reverse multiplier effect. And so what that means is the Fed puts money into the system, but it doesn't go anywhere because there's just not a demand for money right now. The other thing that hardly anybody talks about that I think is probably one of the most significant things that's going on is just demographic changes that are taking place. The baby boomers are getting older. Their risk profiles tend to change. They're really, as they get older, at some point they're sellers. You know, even if they die, they're sellers, right? So they're more or less will be sellers of real estate, stocks, other investments. And so the question is, well, what about the next generation coming up? And probably one of the things that concerns me the most is really the shape that the next generation is in. There's not a lot of talk, although I've heard increasing talk about the amount of student loans. There's $1 trillion worth of student loans that are out there. A typical guy graduates from college, has $25,000 in loans, and they just haven't had the job opportunities because of the high unemployment rates and whatnot. And so, you know, it's like, how are these kids, you know, or young people as they grow up going to be able to keep things going? A lot of them are really discouraged too about home ownership, where they feel like home ownership is too risky. It's kind of like they tried that and they got upside down in their house and they lost a lot of money. So I think that this is one of those things that will be an ongoing story actually for the next probably decade or generation. Just this whole idea of you have kind of an older group of people that need to be supported. There's Social Security, there's pensions, there's all of this sort of stuff. And then you got a younger group of people that really aren't doing that great financially, and they're the ones that have to support these guys. So I think that this is part of the reason we've had slower economic growth. Could be a continued strain on housing prices, especially the upper end. In the Phoenix area, the upper end market has been extremely weak. Lower end housing, went down about 60% or so, and it seems to have bottomed, and it's been strong recently. But it's going to be hard for the upper end market. Okay, so are bonds the next bubble? Well, if we're going to talk about if bonds are a bubble or not, I guess we need to know what a bubble is. And so a bubble is a situation where the price for an asset exceeds its fundamental value by a large margin. Now, when I was younger and in school, the classic case was what they called it tulip mania, which was in Holland, where people were hoarding and going out and paying ridiculous prices for tulip bulbs. I guess to me the most recent phenomenon was these Beanie Babies. My wife was collecting things like there was no tomorrow. You just run into these things. So it's kind of like, to me, that was a bubble. So what are the characteristics of a financial bubble? Primary motivation is greed. People really, they want to be in on it. Prices are going up. There's always somebody that they can turn around and sell it to at a higher price. A suspension of disbelief. In other words, it's just this idea that you don't realize that everybody that's participating in this is, speculating, and that it's really risky. There's widespread participation or involvement. Valuation is just at high levels that historically hasn't been, not a proven valuation method. A lot of speculative activity. Yes, sir.
On that widespread participation, I'm not sure where you're going with this yet, but could the Fed, because if they become such a large buyer, could they in of itself create a bubble though, because they are buying and selling, bonds are coming in and out of the market as well? Could a large institution like that also create a bubble? Is that a risk?
I don't think the Fed's buying bonds because they think they can flip them and make a lot of money, do you? No, I mean, seriously, that's really what we're talking about. People buying homes, no money down. Then it's like, hey, this housing market's so good, maybe I need to have another place. So I need a summer home. So you go out and you buy the summer home. And, it's like, that real estate only has one way to go. It's that kind of thing. I don't think, I hear what you're saying, but I think that is affecting not the price of the bonds. It might be paying what the bonds are paying, So anyway, people always recognize the bubbles afterwards and can explain it clearly, but the favorite topic today is to predict the next bubble, and that's just not how it works. So today, the primary motivation is really fear, and rather than greed. So that's different. Skepticism. Investors are skeptical about inflation being contained. Probably most everybody in here is worried about inflation becoming a big problem. And they're really concerned more about taking market risk than they are about reinvestment risk. There's just that idea that rates can't go any lower, they have to go up. That may happen, but it's not a known event. There's also just what I mentioned earlier is about these demographic changes. Valuation is being driven largely by demographic changes. As the baby boomers have been getting older, there's just stuff going on, an aging population, not only here, but look in Japan, and Japan had the oldest aging population, and so you could see what's happened there first. Then Europe has the same situation, and so do we, all the developed countries. Deleveraging has taken place, so if people are paying down debt, why would rates go higher? Deflationary factors, the economy's growing below trend with high unemployment. So, it's possible, who knows, that maybe we're in more of a Japanese type situation, and we'll be looking back on this 5 or 10 years from now saying, well, we were worried about a bubble, but in actuality, we were just in a Japanese type situation where rates just stayed low for a long time. Anybody have any questions about that?
Yeah, the deficit spending, is that going to eventually drive the interest rates though?
That could happen. And typically, Chris, the way deficit spending tends to become a problem is it's kind of like it's not a problem, and then all of a sudden it becomes a problem. And it really becomes a problem, especially when a lot of your debt is held by foreigners. And so, for example, if you look in Europe, that's one of the biggest problems they have, is their debt's all held by foreigners.
What about ours? China's holds a pretty big portion,
Yep,
don't they?
they own a lot of our debt. So, I mean, that's probably the risk. To me, that's, I don't want to jump the gun and talk about the fiscal cliff yet, but, you know, I'll talk a little bit about that later. But, I mean, that to me is the biggest single worry, let's say, that you might have about rates going higher, is that it's being imposed on us from somebody else. So anyway, most developed countries suffer from too much debt. What happened is all these sovereigns accumulated a lot of debt from the banking systems, and also because their revenues fell because of a weak economy, and they were running deficits. And the economies have been very weak. The monetary policy is ineffective. One of the things that I talked about the last time I was here is I compared California to sovereign debt. And so I put this chart up here again. And one of the things that's actually interesting about this, and this is what I was just talking about, Chris, like right here, for sovereign debt, the debt's held by foreigners. For muni debt, it's held domestically. There's also currency risk. Another thing for sovereigns is they have the power to print money. The problem in Europe is these countries don't have the power to print money. So if you're in Greece, you can't just print a lot of money to get your way out of it. And so it kind of comes back here where, you know, these countries are separate political division, and support from foreigners will likely be more conditional. I mean, that's just exactly what we're seeing in Europe. So I did this chart. CDS is what are their default swaps for, and it's really a way of measuring the market's perception of risk of credit default of a credit default. So in December of 2008, state of California was trading at 455. Greece was at 241, and the argument that people would make is things are so bad here in California that it's twice as bad as Greece. You know, and then you can see Spain was only 104, and you can go down the list on the left. Then on the right, which was just June 30th, you can see state of California now is at 190. Greece went from 241 to over 10,000. Spain is up over 500. Ireland's over 500. Portugal 700. Italy. You can see all of those are really showing that they were actually the ones that were the riskier credits.
It's not a good crowd to be with, though.
No, it's not. But actually,
At least we're moving in the right direction.
well, yeah, but we went from 4-something to 190. That's manageable. If you look at this chart, the two that are on the top there are Italy and Spain. In Italy and Spain, they're like major countries in the euro. So, I mean, that's more alarming than Greece. And this would be the muni credit default swaps. And you can see that the Illinois is in white, and California is right below it. But you can see that they've come down. So what's the effect of the European crisis on munis? Well, there's been a flight to quality, so the demand for treasuries as a safe haven asset. There's been a focus of attention diverted from the U.S., really to Europe. It's been a drag on economic growth because it does affect our export somewhat. And it also, though, another effect that it has is it kind of gives us a glimpse as to what could possibly happen and what things they've tried and what things maybe we should be doing. So another area that I think is really like a hot area right now is this rising cost of public employees. And so Governor Walker, you know, they had this recall election for him. And what he did is he really said that public employees couldn't have collective bargaining. Well, that kind of reminded me of with Reagan and the air traffic controllers back in early 1981, where the air traffic controllers went on strike, and it was actually illegal for federal employees to strike. And Reagan told them that if you did that, then you're going to lose your jobs, and then he replaced them. So I would say that was a right to strike issue. Reagan was also a union person in, like for the Actors Guild, which is really kind of interesting. Anyway, Governor Walker, he just took away the whole right to bargain issue. But to me, what this is really important and what we'll be looking back at someday is just the impact that it has, because public employees the costs have just gotten to be so high as a percentage of budgets, especially out here, probably nowhere worse in the country than out here. And there's been several abuses, where, there's this guy in Bell that was making $850,000 a year, and all this kind of stuff. As taxpayers, I'm sure that's a concern, So anyway, this is an area where people felt like they really had to just give the public employees whatever they wanted, more or less, and that's changing. This is really a battleground right now. And part of the problem is that with Prop 13, municipalities can't raise their taxes, and then when their revenues go down, well, if you can't raise your taxes to increase your revenues, then you have to do it by cutting expenses. And like in the city of Vallejo, they had to get rid of policemen, firemen. That's what we're talking about here. So one of the things that you're probably reading about now are municipal bankruptcies, because that's been big news. Some of the reasons that you see cities go into bankruptcy is maybe they put their guarantee on something that they shouldn't have done. So for example, in Menasha, Wisconsin, they guaranteed a steam project. Then they had massive cost overruns and it didn't work out. Harrisburg, Pennsylvania, they guaranteed an incinerator project that didn't work out. Another one might be like with a lawsuit. Mammoth lost a suit to a developer, and so they declared bankruptcy.
They issued revenue bonds instead of GOs because they've avoided this trouble, you think, on those projects?
Well, one of the things that I'll talk about is this is all about legal provisions and what different entities there are. There's like 50,000 different issuers of municipal bonds. So, for example, let's say with San Bernardino, the city's probably going to go into bankruptcy. If I own City of San Bernardino general obligation bonds, I've got a problem, as a bondholder. But if I own San Bernardino Community College District, it's a completely different entity. It's the county, it's not the city. Or if I own San Bernardino water revenue bonds, that's a completely different entity. It's secured by revenues. So I look at it from a bondholder's point of view. Where these guys went wrong is, they put their guarantee on it. So anyway, we talked a little bit here about these pensions and whatnot, employing, right now a lot of municipalities are struggling with this issue. There's also another problem is like the city of Hercules. They depended on some of the money from the redevelopment agencies, and basically the state just sucked all the money out of those to solve their problems. So the state has kind of like pushed their problems down a notch. So anyway, it comes down to a will to pay. And I think part of the issue right now is, as consumers in general, we seem to be willing to take less service and not pay so that we have a cheaper product. So in other words, we might have tech support on our computer from somebody that speaks a different language, in a foreign country. Or, when you go to a store, you go to a big box store, or people go to Walmart or whatever. There's just a trend of this. And what I see happening is this whole idea of people, they think that they're willing to take less service, as far as municipal services are concerned. But I got to tell you, if something happens to me or one of my kids and I dial 911, I hope somebody shows up, So anyway, priority of payments in California, education you can see is right at the top of the list. And as a taxpayer, a tax refund is at the bottom of the list. So.
And so you look at, when you choose your bonds, this is the kind of stuff you're looking at.
Yes, yeah, and I've got a slide coming right up about that. So what do we do to minimize risk? We buy bonds that I call them pledged revenue bonds. So they might be water or sewer or electric, essential service bonds. We also like local school district bonds, some higher education and bonds in, let's say, high net worth areas in particular. So a Vallejo or a San Bernardino, the city, these cities are just bonds that we probably wouldn't have because we're focused in these other sectors. So for example, if I wanted to buy like a AAA rated municipal bond and I was going to buy, I don't know, maybe Stanford or something like that, I'm going to get a lower yield, no question about it. But maybe if I was going to buy an A-rated bond that's a local school district versus an A-rated city, GO, I might not really get any lower yield. They tend to trade kind of similar. However, once people get a feel for the fact that you're having some problems, then the yields go up, I mean, and you just saw it in Europe or, with those other things. You follow me? Okay. So anyway, from studying Vallejo, these were some of the lessons that we learned, where the renegotiating contracts, you can reduce liabilities. The problem is it's not like in a regular, municipal bankruptcy is different. It's not like regular bankruptcy where if you or I went into bankruptcy, we can discharge debt. They can't do that. They still have to negotiate with bondholders and whatnot. The fiscal cliff, that's kind of the hot thing that people are concerned about right now, where the Bush tax cuts are basically set to expire and cuts in expenditures are set to take place. Who knows what the politicians are going to do with this? I mean, I think it's virtually impossible to predict this. However, one thing I would say is in my mind, it's like taxes are most likely to go higher. Though if you try to think like a politician, you'd probably want to try and raise taxes in a way that it doesn't make it look like you're raising taxes, That just seems like that's how they work. So there'll be, I would expect tax reform is probably going to be the hot topic here. And on the expenditure side, I mean, there are certain entitlement programs that are just completely out of control that the costs have to be reined in. So how worried should we be about it? Well, there's absolutely no question that austerity tends to be a drag on economic growth. Sometimes it's like no pain, no gain. Now, let's say for example, you're overweight and your doctor tells you you need to lose weight. What are you going to do? You're probably going to diet or exercise. Or you're going to say, oh, who cares what he thinks, right? But it's going to be one of the two. So let's just pretend that maybe one of those is cutting taxes or increasing taxes, and maybe the other, or working something out on the revenue side, and the other is expenditures. There's just not a magic formula here. You know, it's not like you cannot have, you're going to have a drag on the economy over the short term when you have austerity. I mean, that's a fact of life. But if you don't get yourself into a sound fiscal position, then you run the risk of having just way bigger problems later on. So that's kind of the problem. So
what's the solution?
What's the solution? Yeah, well, I'm a bond manager, you know.
Answer the question.
You're a big shot, you know all this stuff.
The solution is that taxes are going to have to go up somewhat. Expenditures are going to have to be cut. You're seeing things that actually on the state and local level, even though I know you turn on your TV and you see all kinds of bad stuff, there's actually good stuff taking place in there. I mean, people are balancing their budgets. The state of California's budget situation is way better today than it was 3 years ago. And so just seeing the progress that's been made there. You've also seen certain politicians mostly at the state level that have really taken a stand and made tough choices, you know, like Christie or Walker, and done what is necessary. And I think you're just going to have to see some of that take place. So it's kind of like, I think that the politicians aren't going to do something in Washington until they have to, but they're getting really close to having to, in my opinion.
And as part of the austerity and maybe the weakness outside of the U.S. and foreign countries, is that what's keeping the interest rates down right now?
Yeah, I mean, you basically have a situation. What causes rates to go up are inflationary expectations or economies that are growing above trend in general, you know. And you've got economies that are relatively weak. You also have no real demand for money to be when the economy is weak, you're not out expanding your facilities and spending money and hiring people. So that's part of the problem. And so I see that as just an ongoing thing. I basically would be in a mindset that, yeah, we're in a low rate environment, but it's not a known event that rates have to go higher because they're low. It's possible rates could just stay low for a long time. And actually, that doesn't mean there aren't values out there. I mean, I've bought, like a 10-year treasury you mentioned was under 2%. It's like 150. So, I mean, for example, recently I've bought some bonds sort of in that 10-year part of the curve, which would be real comparable maturity-wise with treasuries that are tax-free, let's say at 3% for a single A-rated bond. Well, if you can get 3% tax-free, that's twice as much yield as a taxable treasury. I mean, that's not horrible, you know. It might not be 10 or 12% like some of us remember, but, you know.
How far out are you going on your maturities now, Len? Are you taking them out a little bit further because you think because the yield curve kind of allows for that, or?
Yeah, in general, the problem right now is you really you get penalized for being short. So I mean, if you have money in a money market fund, you might as well just stick it in your mattress, you know. So you're getting virtually nothing. And even, I would say the best values are probably out in that 7 to 10 year part of the curve. Now that being said, I mean, I build customized portfolios for clients where if somebody wants to have a real long portfolio, we do that. The trend or the ramifications of a zero interest rate Fed policy is it pushes investors out the yield curve in search of higher yields, and it tends to push them down in quality in search of higher yields. And while I'm willing to go down somewhat in quality, I have some, principles. I mean, I'm not going to go by just junk, People don't hire me to blow them up. So I'm really a conservative fixed income money manager. But so an A-rated bond, if it's a local school district, is still very, very conservative, safe investment. And so that kind of stuff.
So what would you, let's say 7 to 10 years, put a portfolio together on the tax-free, California tax-free side, what kind of yield you'd be looking, and maybe on the taxable side, inside of an IRA, for example. What are you looking at now from a yield?
I would say yields, let's say, you're looking at probably 2.50 to 3%.
On the tax-free side?
Yeah.
How about on the taxable side?
On the taxable sides, I try to get 4%, but I'm having a really hard time. Part of the problem is that the amount of taxable supply in the muni market this year is back down to maybe 6-7% of the whole market. So it's a reduced amount of supply. But I bought something yesterday, for example, in, let's see, it would be 6 years at 3% taxable. So, I mean, that's quite a bit more than where a treasury would be in that range.
Yes. You mentioned avoiding junk, but I can understand buying a small portfolio from stuff you have a high risk. But if you diversify enough in a particular area that is high yield and low quality, don't you pretty much avoid the risk unless that whole side of the equation falls off a cliff?
Well, the answer to that question is, well, first of all, that's not what I do, okay? I'm not a high yield money manager. But one of the reasons we don't do high yield, in fact, the primary reason we don't, is because the correlation between high yield bonds and equities is extremely high. So Chris won't get the diversification against his stock portfolio by working with me if I've got a high yield bond portfolio. I mean, he might as well just buy more stocks.
Yeah, we look at high yield more, like you said, as an equity play than a bond play.
Yeah. But so what does that mean? Basically, you're buying a portfolio of bonds that are going to be really heavily subject to what the economy does. So if the economy muddles along or does better, you're great. And if the economy tanks,
Do you see the dollar in any kind of trouble with respect to being the gold standard of the world? Some people are talking about the Chinese yuan taking over. I've got an idiotic brother-in-law that keeps telling me that. And I'm wondering if there's any truth to that. Do you think the yuan's going to overtake us, or do you think that trade deficit's something the Chinese want to keep in place and keep their money in a better perspective to the U.S. dollar?
well, the way I view our relationship with the Chinese is it's kind of like vendor financing. The Chinese have a huge issue. It's kind of like, it's like they let the genie out of the bottle with their workers, and now they've had a taste of some success and some jingle in their pocket, and that kind of stuff. And so people, they're going to want to increase their standard of living, and the way they do that is by manufacturing and selling stuff to us, and then the country of, more or less subsidizes that or finances it with
So if
us.
they strengthen their currency to the dollar, they're going to have a harder time selling to us.
Yes, and that's why they're so reluctant to do that. That's just it in a nutshell.
Trying to throw spaghetti against the wall, it just doesn't stick.
The problem, one of the problems that you have with the currencies right now is you can say, oh, you know all the problems we have here, but you don't know all the problems they have in Europe. You ought to see these numbers, these debt numbers for Japan. I mean, they are like astronomical. All the things that we're doing, Japan's been doing for the last 15 years. So, anybody else? Or?
About 5 more minutes left.
Okay. Well, I'm just about at the end, so that's why. So, to me, the question is, can we borrow our way out of this? And it's kind of like I was telling this gentleman earlier. What is the problem? If the problem is you have too much debt, if you borrow more money, does that solve your problem? I mean, just think about it. It just doesn't make sense. Now, if you have a liquidity problem, that's different. because sometimes you might see situations where you have a liquidity issue. You can just go ahead and help a guy get through that, and then things get a little better and he's fine. But what we have here is a structural problem. So anyway, just to kind of summarize things, more or less I feel like we're in a low rate environment. We'll probably be in it for a long time. I also think that security selection, the actual bonds that you buy, are extremely important and probably never have been more important than in my career. There's also this problem of too much debt around the world. The ideal situation would be for us to just grow our way out of it and gradually work our way down in debt levels over the next several years. It's going to take a long time. And the other thing that I can see here is there's just this potential for sort of a generational clash, between the younger people and the older people. And there's just so much that the next generation is really going to be able to afford. And so I just think that'll be a huge issue in the future. So, thank you.
Well, Len, thank you very much.
Okay.